and mono. Right? You can see that we have the capital accounts. Right? It shows how much capital each partner has put into the business. We have the current accounts, which show how the partners share their profits or losses. All right. We have the cash drawings for the year, which shows how much each partner has removed from the business. Okay. But basically, the question has told us we have to make an income statement for this partnership. All right. So the information we're going to be focusing mostly on is here, from freehold premises at cost to allowance for depreciation on fixtures and fittings. Some of this information will go in the balance sheet and some of it is going to go in the income statement. Right? So let's focus first on the additional information. Right? Inventory was valued at 163,000. That's our closing inventory. Purchase invoices amounting to 6,000 for goods included in the inventory valuation in A have not been recorded, right? So basically the accountant forgot to record these purchase invoices. So what we're going to do is we're going to add them with our purchases, right? We have staff salaries owing 1,800. This is an accrual, all right? An accrual is a liability to be registered in the balance sheet, and accruals are going to be added in the income statement, right? Accruals are added, prepayments are subtracted, right? As we can see also here, we have a prepayment, business rates paid in advance, 400 kwacha. That's a prepayment, which we also take as an asset, right? Then we have allowance for irrecoverable receivables to be increased to 4,800, right? So we've been told there's been an increase in the allowance for irrecoverable receivables. So this increase is going to be added to our expenses. What we just have to do is we have to find out how much it has increased. So if we go to our balance sheet, we see allowance for irrecoverables is 4,000, right? So we'll just say 4,800 minus 4,000 and we get an 800 kwacha increase. Okay. Goods withdrawn by partners for private use have not been recorded and were valued at Sakala took goods worth 1,000, Mono took goods worth 1,260. So no interest is to be charged on these amounts. So basically, this total amount of goods also going to subtract it from our purchases. Okay. Allowance is to be made for depreciation of fixtures and fittings at 10% on cost. Okay, so we'll get 10% of um, the cost for fixtures and fittings, which is 30,000 here. And interest on drawings for the year is to be charged Sakala 720 and Mono 560. All right, so the first thing is we're going to make the trading account. Okay, the trading account. So let's say trading account for Sakala and Mono. For the year ended 30th June 2017. All right, so we're going to start. I'm going to say sales. All right, we go to our trial balance. We're going to look sales. How much is sales? Okay, so here we have sales and sales returns. All right, so we have 12,000, which is the debit, and 1,016,000, which is on the credit. So we're going to get our value on the credit side.
Excuse me, sir. Are you able to increase the screen size a bit?
Okay, maybe like this. Okay. So we're going to go to sales and sales returns, as we can see here. Sales and sales returns. So the figure on the credit side is going to be our sales, all right? Remember, sales increase revenue, and an increase in sales increase capital, okay, because sales are a form of revenue, and that's why revenues are credited. So we're going to say sales. We're going to record our figure 1,016,000. 16,000, right? Then our sales returns is 12,000, all right? Sales returns, these are goods customers bring back. So we're going to say less sales returns. I might need to expand this a bit. Less sales returns. Sales returns was at 12,000, right? So we're basically calculating our turnover. All right, so I'm going to say 1,016,000 minus 12,000, right? So turnover is 1,004,000, all right? 1,004,000. Right now, we're going to focus on the cost of sales. Okay, cost of sales. Right? We're going to put first our opening inventory. Okay, our opening inventory is how much we're going to see here. Inventory at 1st July 2016, 150,000, right? So we're going to put here 150,000. Okay. Next, we're going to go to our purchases. Right. Now, remember, Sakala and Mono took out goods from the company, okay? Goods from the business. Sakala took goods worth 1,000. Mono took goods worth 1,260. So we'll add these two up, we get 2,260, and we'll deduct this from our purchases, okay? So we'll go to our trial balance. Okay, we have purchases and purchases returns, all right? So purchases is on the debit side. We get this figure on the debit side, okay, for purchases. So we're going to say purchases, we're going to say 760,000. No, I think 60,000 minus 2,260, right? We're going to get 757,740. Okay, let me just confirm that figure. 760,000 minus 22. Yes, 757,740. Here it will be this. Okay, so 757,740. Then you also, if you remember on our additional information, it says purchase invoices amounting to 6,000 for goods included in inventory valuation have not been recorded. So we're going to add that. So I'm going to say add, all right? Say error of invoice omission, okay? Forgot to record, the accountant forgot to record this, right? And that was 6,000, okay? And then we've got carriage inwards. Okay, carriage inwards. What is the amount for carriage inwards? We have 43,000. 43,000. Right. Also add carriage inwards. All right. And then we're going to have to now also subtract our purchase returns. Okay, we'll say less purchase returns. Okay. Less purchase returns. All right. So our purchase returns, okay, we have 24,000 here. 24,000. So what we're going to do is we're going to add these three, then we're going to subtract 24,000. So let me just illustrate that here. Okay, which is 757,740 plus 6,000 plus 43,000, we get 806,740. All right, then we're going to subtract it by 24,000. Okay, so here I'm just going to put a line here. Okay, so we're going to say 806,740 minus 24,000, you get 782,740. Okay, so what we're going to do now is we're going to add our opening inventory with this, get the total total available goods for sale. All right, so what I'll do is this here. All right, I'm going to add these two. Okay, so we're going to say 150,000 plus 782,740. We're going to get 932,740. And we're going to say less closing inventory, right? Well, given our value for closing inventory, it was 136,000. Okay, as you can see here, closing inventory 136,000. So less closing inventory, we're going to say 136,000, right? Okay, we're going to get 796,740. Okay, so now we want to find our gross profit. Okay, our gross profit, we're going to say gross profit, okay, is equals sales minus cost of sales. So gross profit equal, let's say, subtract from here. And our gross profit is 207,260. So that's the purpose of the trading account, so that we can calculate our gross profit, and our gross profit has been found.